stay stateside thematically. Investors are waiting for US jobs data out today that will shape views on Fed policy. The US is forecast to have added 725,000 jobs in August, which is a more moderate pace than June and July, but stronger than early 2021. What messaging should we take from the jobs report? What should we look for? Frédéric Carrier is RBC Wealth Management Head of Investment Strategy and joins us now. Frédéric, good to speak to you. I've been intrigued by a lot of the analysis I've been reading overnight, suggesting that bad news could be good news and good news could be bad news when it comes to linking jobs and risk assets because of our obsession with what the data will mean for the taper. How are you approaching this jobs report?
Look, we expect 730,000 jobs to be announced today, slightly less than last month. But last month there was a seasonal bump from education jobs, which will not be repeated. So that level would be a strong level of jobs. The Fed absolutely needs that in order to proceed with tapering. So whether that would be enough for it to proceed at the September meeting, to announce it at the September meeting or not, remains to be seen. We do think there's going to be an announcement of tapering September or in November, but that taper will start early next year. There's a lot of focus on the exact date of the announcement. We tell our investors that they have to remember that even though there is a taper, the policy will remain accommodative, monetary policy will remain accommodative for a very long time, and we're not looking at an increase in interest rates until 2023. So that will underpin stock markets in our view.
Good morning, Frédéric. You're expecting 730,000, pretty much in line with the consensus, though I know the Whisper estimates are a little bit lower. I'm curious, what are your kind of binary trigger levels on either side where you go, whoa, this is going to, force the Fed to announce taper in September? Like, so what's the top side level? And what's the downside level where you kind of go, whoa, tapering's, off the cards in September. It might not even be on the cards in November. Where are your two kind of limits on either side?
So we would say anything with a difference of 200,000 jobs would be these sort of limits, trigger limits. But remember that the Fed is not only looking at labor, it's also looking at inflation, and the resurgence of COVID would also weigh on its decision. And the way things are going, there could be a bit of a slowdown later in the year if some restrictions, certainly not full-blown as we've seen in the past, but some restrictions are inputted if consumer confidence starts to wane slightly. So it's more than one data point. I think the Fed will look at the overall picture, and the bar for increasing interest rates certainly is very, very high in its view.
Let me ask you about the broader picture in the jobs market, the sort of level of dysfunction we see in the US jobs market at this point, Frédéric, just because, it's the US we're talking about today. But to some extent, this seems to exist in other markets as well. That dysfunction illustrated just overnight in some data I was looking at, 50% of small businesses in the United States have vacant positions. This is a really high level compared to history. And 41% of small businesses say that they have had to increase wages. I wonder how much that dysfunction is again going to be temporary. If we're looking at this as a sign that inflation might be with us for longer, maybe that dysfunction is temporary and therefore we shouldn't read too much into it. What is your sense around that broader status of the US jobs market?
So we think it will work itself out in time. So there's clearly a big debate about temporary. Temporary does not mean 1 month or two. It could mean a number of months. Does it herald wage inflation? We've seen wage inflation in the US be relatively subdued overall. There are some pockets where things are flaring out, but overall, it is not stratospheric. So this gives us some confidence that with time, this unemployment rate of 5.4% will continue to fall.
Frédéric, thanks very much. Stay with us. Frédéric Carrier, RBC Wealth Management.